I had the opportunity of speaking with Steve Cress, the head of quantitative strategies at Seeking Alpha. Steve is the brains behind the quantitative analysis that is used by over 250,000 investors on seekingalpha.com. Stocks identified by Steve's quantitative score of strong buy have an average annual return of over 25%. In our conversation, we discuss why dividend investors should care about quantitative analysis, as well as how dividend investors can make data-driven decisions for wealth accumulation, as well as wealth preservation. I hope that this conversation adds to your understanding of quantitative analysis as much as it did for me, and how dividend investors can leverage Seeking Alpha's quantitative analysis to make more data-driven decisions. If you get value from this video, please consider trying Seeking Alpha Premium. You will find a link in the description of this video with a coupon code where you can get Seeking Alpha Premium as well as Alpha Picks. Steve, thank you so much for joining. Welcome to the channel.
Thanks so much for having me. I really appreciate being here.
Before we dive into it here, why don't we take a second, and it would be great if you could give a brief introduction to your background. Who is Stephen Cress?
Sure. Well, I have been in the world of finance for over 30 years. The bulk of my career was spent at Morgan Stanley. I was there for 14 years. And for a large part of that portion, I ran a proprietary trading desk in quantitative strategies. After Morgan Stanley, I went to the buy side and I worked at Northern Trust Asset Management. And eventually I launched my own hedge fund in quantitative strategies. When I was running the hedge fund, I was based in London. I lived there for about 11 years before coming back to the United States. But while I was there running it, I also created a fintech company, which was called Cress Cap Investment Research. And the reason why I highlight that is Seeking Alpha actually bought Cress Cap Investment Research. And part of the deal was for me to join and integrate the technology that I created, which in a nutshell was really an automated research analyst, giving people the ability to put the name of a company in and get a fresh research report every day with a directional recommendation. So I joined Seeking Alpha about 4 years ago when they bought my firm, and I've been working for them ever since. And I have to say, I think the platform looks really good. It's a great marriage of what they had prior to becoming was crowdsourced research. So many individuals submitting their opinions and articles on stocks that they were familiar and intimate with, as well as news. And then we brought the quantitative aspect. So it's a really good balance of qualitative opinions and quantitative research.
Well, I think, having been using Seeking Alpha for years now, I've always seen these grades, these quant scores, Seeking Alpha, Wall Street analyst scores. And it's always intrigued me, seeing when, there was a strong buy for a stock versus a sell. And when I first started investing, I didn't really, I could appreciate that, but I didn't really understand really what it meant. And so to dive right in, what is quantitative analysis?
So quantitative analysis is really the same thing as a fundamental research analyst. You have a Wall Street analyst who will cover a company and a sector. And when they're looking at that company, they're looking at investment fundamentals. They're looking at valuation. They're looking at profitability. They're looking at growth. And they'll cover one company, and perhaps in the entire sector that they follow, they may cover 15 stocks. Quantitative research, in essence, it's the same thing, but on steroids. Instead of just looking at one stock and comparing it to a sector, we're looking at thousands and thousands of stocks. And through the power of computer processing, we take the cash flow, the income statement, the balance sheet, and a tremendous array of financial metrics for value, growth, profitability, and we calculate those every single day. So we're looking at fresh opinions based on the investment assessment that we've done on these companies, which is the same type of assessment that a professional analyst would do. We're just doing it for almost all companies and using the power of computers to separate the strong from the weak. And when I say separate the strong from the weak, when we look at valuation, we're looking at what companies offer better value. So by example, if you're looking at Exxon, you want to see how the value of Exxon compares to the rest of the energy sector. If you're looking at Microsoft, you want to see how growth compares for Microsoft to the rest of the sector. And that's what we do. And we do it in a way that's really user friendly. So when you take a look at the stock page, you'll literally see these academic letter grades, A through F, and you'll see it for those overall investment styles such as value and growth and profitability. But if you want to take a deeper dive, you can click into value and you'd see all the underlying metrics such as PE or price to sales or price to book. And again, we're providing that instant characterization. So when you see that letter grade, you can know how the PE compares to the rest of the sector. So really, that's sort of a top and bottom down approach for quant. I consider it the same thing that an investment research analyst utilizes. It's just instead of doing it one stock at a time, reading one annual report at a time, we're doing it for thousands and thousands of companies.
Okay, interesting. So I want to, so that I can understand this, I just want to make sure, as you know, for somebody that's new to investing or new to this, the way that I've kind of thought about this in the past, when I look at Wall Street analysts or Seeking Alpha analysts on the platform, and I see different articles and buy ratings or sell ratings, it kind of, the way that I kind of think about it is it's more of emotional. That's what their opinion is, subjective. Whereas with quantitative analysis, my understanding is that it's not based off of emotions or people's opinions, but rather just pure facts derived from
data. Yeah.
Is that correct? I'm on the right path.
It's based on the data. So we're looking at historical data and we're looking at forward data. But what we're not doing is interviewing management teams, CEOs, CFOs. We're not talking to analysts or industry experts. We solely rely on the data that's there. So we look at what a company has reported, which comes through the SEC, and then gets scrubbed by our data vendor, which is S&P Global. So we're looking at all the historical data, again, going back to like cash flow and income statement, as well as financial metrics. But we also look at forward data as well. With the forward data, we're looking at revenue and EPS growth estimates, but those estimates are coming in from professional analysts, and we're using the consensus EPS and the consensus revenue and the consensus EBITDA. So that's how we sort of incorporate the future into our algorithm as well. But it's just looking at the data that's there. And when we look at the data, we create a score for each of these metrics so we could see how it compares to the rest of the sector. But we are not talking to any individuals to generate our directional recommendations. It's all based on the data. And the companies that have the highest score get the strong buys, and the ones with the lowest score are the strong sells.
Okay, great. And I think what's important to note, and you already mentioned this, is you're looking at, did you say thousands or hundreds of data?
Thousands.
Yeah. Okay.
Yeah. So in the, I think we cover about 4,700 stocks in with U.S. securities and ADRs, and those are almost all majorly, and not even majorly traded companies. That's a lot of small cap, mid cap, and large cap names when you have about 4,700 stocks.
Interesting. And so, when I think about this, would this be relevant for investors who are value investors as well as technical investors? Like how would somebody use that, when looking at those different methods of investing?
Yeah, that's a really good question. The way that our model works is it's almost what's called a GARP approach, which is growth at a reasonable price. So if you are a value investor, you would be able to look at these recommendations that we have that are strong buy or a strong sell, and know that if something is a strong buy, it's a pretty reasonable value. And chances are, if it's a strong sell, it could be a stock that's fairly expensive. Having said that, individuals who come onto our platform have the ability to use screens. So you could literally, if you really like companies that are cheap, you could sort of screen it by that metric and look for, on a quant basis, companies for value that just have an A through an A plus. And that equates to companies that are very inexpensive versus their sector. If on a value basis, something had an F grade, that means it would be very expensive versus the sector. Alternatively, you could also just screen by the absolute data points as well. So being that you could look at it, if something's got a multiple of 2 times or 3 times or 4 times, it screens as inexpensive. You could find companies that way as well.
Great. So it's really a powerful tool that, when you're going through and looking at different stocks, it's not just a number and that's all you see on the front end, but actually what's happening on the back end is a lot. There's a
Yeah,
lot more to it.
I'm glad you mentioned that number, because I think people often ask me, how did I come up with the concept of creating like the letter grades? And even as a quant, like, when you're looking at numbers all day long, or what we call Z scores, your eyes are tearing by the end of the day. Um, the benefit of having those academic letter grades that are color coded is it provides you sort of with that instant characterization of the strength of a weakness or a number. So it's much better and easier to look at that than look at something that's 3.1 or 2.5 or 1.888. Much easier to look at the academic letter grades, and again, it gives you that instant characterization.
When we think about this from a dividend investor's perspective, right? So how
Sure.
dividend investors can leverage Seeking Alpha's quantitative analysis to make better or more data-driven investment decisions. Why should dividend investors care about quantitative analysis?
Well, we, outside of having grades on the fundamental factors such as value and growth and profitability, we also have dividend grades as well. And this is really why they should care. It's because we did a tremendous amount of back testing to uncover which metrics provided the highest degree of dividend safety. And sometimes a picture is worth 1,000 words. So if you don't mind, I'll actually show my screen. This is, in case you need a friendly reminder, this is actually on the Seeking Alpha platform in the About section. And this is quant dividend grades. And what we do is review how the process and the methodology and the strategy behind the dividend grades that we created. And really, there are a couple aspects to dividend grades that are important. One is dividend safety, the other is dividend growth. But I'd like to just briefly tell you sort of the history in back testing, going back to 2010 on our dividend safety grades. And what we found when we finally arrived at the metrics that we wanted to use for dividend safety, we found that 99% of dividend cuts were averted. So you did not experience a dividend cut
Wow.
if you owned a stock where the dividend safety grade was A+ to A-. A little bit further down, we found that 98% of the dividend cuts were averted from A+ to B-. So that really even widened the spectrum further, showing that if you basically had a stock that was B- or above, almost very, very rarely was that dividend cut. Now, when we went a little bit lower, we found that 93% of all the stocks that cut their dividends, when those cuts occurred, the dividend safety grade was C+ to F. And we found that 67% of all the stocks that had a dividend safety grade of F had cut their dividend. And then we found during the year 2020, which was, of course, was during the pandemic period, 51% of all stocks that had a dividend safety grade of F at the start of August 2020 had cut their dividend within the next 12 calendar months. So it's a really powerful scoring system. It's been back tested over a 13-year period. And as you can see, if you want to avoid those dividend cuts, just find stocks where that dividend safety grade is above B-. But if you own a stock, especially one where the dividend safety grade is, in the territory of F to, C-, C, you really want to be careful. The other aspect that we looked at dividend growth is if you took companies that had a dividend growth grade that was A- to A+. I'm sorry, if you took the dividend growth grades that were A+, just A+, you could see that the return was significantly over the benchmark that we compare it to. So there's a benefit from looking at dividend growth as well as dividend safety. I'm going to switch my screen now. And what I want to show you is a picture of companies that we show you want to avoid. So basically, this is on the Seeking Alpha platform. So what we have here is a portfolio screenshot of companies that you want to avoid. And it's actually not a screenshot. This is a live screen. So if you go into the Seeking Alpha platform and you select dividend stocks to avoid, you can see there are 30 names that come up right away. So this is a good sort of safety check. If you're concerned that you might have a stock that's one you really want to avoid, you could always take a look at this preset screen. And what it shows is companies that have a strong sell or sell quant rating. And these companies also have very poor dividend grades. So you can see here are the quant ratings. And if you scroll down, you'll see that there are some companies that are pretty well known. Cracker Barrel is really well known, Dine Brands, Levi Strauss, Foot Locker. So these are definitely companies that people could possibly have in their portfolio. And this shows the quant rating, and it shows the fundamental metrics that people commonly look at: valuation, growth, profitability, EPS revisions. But if you click on the dividend tab, it will show you what the dividend safety grade is, the dividend growth grade, consistency, and yield. And you could see that there are a lot of Fs and D minuses. And these are the companies that you do not want to either own the stock or be trusting on that dividend, because there's a high probability. It's not a guarantee that these companies will cut their dividends, but what the data is telling you compared to their sectors, the safety metrics that we look at are not great. And here I can give you sort of an example of what a safety metric looks like. I'm going to click on Levi Strauss on the dividend safety grade, and this will actually show you all the underlying metrics that we look at. And there could be some metrics here that people might say, well, this isn't really so bad, because you'll see some C minuses and you see the interest coverage is a B. And a lot of people will maybe just look at interest coverage or dividend coverage and leave it alone. But you can see that dividend payout is a D plus. And then when you scroll down, and this is one that I love to look at, is the cash per share. This is so ignored, but you can see the average for the sector is about $3.19. And for Levi's, it's only $1.19. So that cash per share is really low compared to other companies in the sector. And then when you look at the log of unadjusted stock price, that's very low. The 60-month capital asset pricing model is an F for it. And then one thing that's a real telltale is, do a lot of institutions own this stock? And you can see with Levi, it's actually really under-owned by institutions. And I kind of trust that institutional view because they have professional analysts that are looking at these companies. So in the case of Levi, you can see the institutional ownership is only 25%. Compared to the average for this sector, the institutional ownership would be around 65%. So that to me raises a flag. And then, of course, you can see percent of total downward dividend per share revisions. And these are analysts that actually have revised their dividend per share estimates, not the earnings per share estimate, but the dividend per share estimate has been revised down by analysts. So, those are some warning signs, and that's why we have that up there. I could give you an example of a couple companies that we cover that had really poor grades and actually cut their dividend that were big names. So I'm going to switch over from Levi Strauss to a company that's really popular, Advanced Auto Parts. This was a company that a lot of people did not expect to see the dividend cut. And back in May of this year, they did cut their dividend. We did have and still have a poor dividend safety grade. It's a D now. And I believe it was a D back in May as well. The quant rating is also a strong sell in the stock, and we absolutely got that right from a quant perspective. You can see year to date, the stock is down 54%. And then when you go to the end of May, you can see a big drop in the stock price, and that's when they had cut their dividend. And if you take a deeper dive into it and we click on dividend safety, you should see the underlying metrics here. And the dividend safety payout ratio is a D. On both a GAAP and non-GAAP basis, it's a D. If you scroll down, you'll see the debt to equity is a D plus on it. And then you'll see things, metrics like the 60-month capital asset pricing, it's a D minus. Dividend growth rate, obviously a D minus. Dividend coverage, a D plus. So surprisingly, the company does have a fair amount of cash per share on hand. But as you can see, we have other metrics that we assess that led us to that dividend safety score being a D. So I think what's really important to highlight, I mentioned that I do like cash per share, but you really can't pay attention just to one metric. You have to take a look at the overall metrics. So that's exactly what we do. And we score each of these metrics. And what happens for a company like Advanced Auto Parts, the overall score is pretty low versus the sector. And that's why it has a D. I'm going to switch to another.
Well, here, really quick, a quick question for you before you switch. Is there a way to see when Seeking Alpha flagged the rating on a timeline basis?
Absolutely. Yeah. It's a very transparent system. I really pride myself on the transparency. So if you just click on ratings,
Mhm. Oh, there it is. Okay.
you could see that back, I think it was around February 2nd, we went to our first sell, and the stock had been a sell. And then it went to sort of a hold pattern from there. And then we reiterated our sell back in March. And then in April, it went to sort of a hold status from that sell. And then they had cut their dividend. We went back to sell again. So you can
Mhm.
see that it's been teetering sort of between sell mode and a hold pattern. But usually when that sell mode kicks in, that you really want to pay attention to that.
Interesting.
And I think if you you can see where I'm scrolling, and we're scrolled over all the way,
Hmm.
and you can see the EPS revisions. You know what we don't have at this point is the rating history for the dividend grades, but that's something to sort of include in our next version. So
Yeah.
I'm glad that you mentioned that. Right now, sometimes there's too much data. Um, but I think some people might be interested to see when those dividend safety grades get flagged. So that's something that we certainly can include going forward is a history of the dividend safety grades. Okay, here we are on Newell Brands, another company that's fairly well known. It's got a market cap of about $4 billion. You can see year to date, the stock is down about 28%, and it has a quant rating of sell. As we scroll down, you can see the dividend safety is an F on this. So again, those warning flags are there, and I'm going to click on the dividend safety. So you can see what those underlying metrics are that lead it to an F. And an F is seriously like, a potential danger zone. And you can see with this company that for the dividend payout ratio, it's a D. You could see that for the cash flow payout ratio, it's a D plus. You can see the dividend coverage, and this is a very popular one, is a D minus. And again, what we're doing, these grades simply reflect what the metric for the company is compared to the sector. So it's giving you sort of that instant characterization if it's strong or weak for this versus the sector. But you can see we provide that absolute data point as well. So by example, on dividend coverage, you can see the metric is 1.58 versus for the sector, it's 2.9. So it's 45% below the sector. Same for the interest coverage at 2.51. It's well below the sector where the median interest coverage is at 9.19. Net debt to assets is a D, debt to equity is a D, net income margin, return on equity, really poor grades that we're seeing here. Cash per share is 65 cents versus the sector at $3.19. So you can see that we don't take this lightly. We really assess a lot of metrics to come up with the dividend safety grades and dividend growth. There's just a wealth of information that you can find. You have
Yeah.
the dividend scorecard, which will sort of provide an overview for all of it. But if you're if you're focused on, the yield, you could take a look at the yield history here and see. I'm sorry, this is the yield grade, and this can really set people off into sort of traps. Often, they might see something that has a dividend yield grade of A and say, "Wow,
Yeah.
this is great." All it's indicating is that the yield is higher than the sector, but a higher yield can sometimes mean danger. The higher the yield, the riskier the security could be. And that's why when you want to consider a dividend safety, you want to look at the dividend safety grade. The dividend yield just shows you how that yield is versus the rest of the sector. We could look at the dividend growth rate as well. And dividend growth tells more of a story. Really, when you buy a stock for dividends, you really don't want to focus just on dividend yield. You want a combination of dividend growth and dividend safety. And if your dividend growth scores are poor and your dividend safety scores are poor, you pretty much want to avoid that stock.
Right, so Steve, this is really interesting. I guess something that came to mind as you were explaining this with the dividend safety and forward looking. You mentioned during the pandemic of 2020 that you had already flagged. I think it was, correct me if I'm wrong, around 50+% of the companies that did end up cutting their dividend. How, because when I think about dividend cuts, I think of kind of those black swan events for most companies, right? 2008, 2009, a bunch of companies cut their dividend, and then just dividend cuts generally, if you look at the masses, don't happen just every year, right? You see them in
There's
clusters
usually a couple
together.
every year, but certainly
Yeah.
not like we saw in 2020. Yeah, but the reason why I highlighted Advanced Auto Parts and Newell Brands and Big Lots, those are all companies that cut their dividend this year.
When it comes to the dividend projections, we're just talking about the dividends or the dividend safety. It's just the dividend stocks. This does not apply to ETFs. Is that correct?
On the REITs, we actually have dividend scores. On the ETFs, we do not have dividend scores.
Switching gears here a little bit, when we think about this, when I think about the audience here watching this video, everyone's in a different stage of their life, right? Everyone has a different investing time horizon. If somebody's early on in their investing, experience here when trying to build wealth, they're in that wealth accumulation stage. How can someone who's maybe in their early 20s or 30s, who's just getting started, how can they leverage quantitative analysis to generate and build wealth?
Yeah, that's a great question. I think, certainly when you're in an earlier stage of your investment life, you want to focus on capital appreciation. Uh, the way it would transcend is you go from capital appreciation, and then when you're a bit older, you want to go to capital preservation, and then you want to focus on income generation. When you're in your earlier years, and earlier years could be anything really below 50 or 60, I tend to tell people to focus on investing with a discipline. And that discipline is to ignore what you're hearing from the talking heads on CNBC and Bloomberg, not to worry about the overall market and its swings. Are we having a 20 or 30% pullback, or are we in a raging bull market? If you focus too much on that, you'll lose your investment discipline. So what you really want to do is probably pick out on a monthly or quarterly basis periods to sort of just assess a couple of top stocks and invest in those names. And if you want to really take advantage of some vehicles that are out there, if you have an IRA, you could focus on splitting up between taxable and non-taxable. So you could have, say, if an account at Schwab or Fidelity or E-Trade, where you're going to put in stocks that could be growth names or growth at a reasonable price, and have that as a trading account. And then your non-taxable account, which would be your IRA, you may want to focus on putting your dividend stocks in that because it won't be taxed. So I kind of like to split it between a taxable and non-taxable account. And for the real capital appreciation, I'll put that in the taxable. For names where I want to start building up income, I would focus on owning those dividend stocks in the IRA account.
I really like that. I might even steal that the discipline, right? I've termed that as guidelines in the past, but I like discipline a little bit more. When you think about investing, you're not investing into hyper growth companies like a Tesla or a Bitcoin that's going to 10x overnight. You really have to be disciplined. And when you're putting together this strategy or this plan, something that I've found is if you're not willing to, invest into something, for decades to, kind of piggyback off of Warren Buffett, then why invest into it at all? Now, everyone has their own, preference of how they want to generate and build wealth. But when looking at my audience here on YouTube, we're focused on building generational wealth through dividend investing, right? You're not selling off a portion of your portfolio each year to fund your livelihood, but rather you're living off of the income that your dividend assets are producing, that you will one day hopefully pass on to future generations. Now that's very different, when you're thinking about, the growth and capital appreciation compared to somebody that maybe is entering, the next phase of life, and they're more focused on wealth preservation. What advice would you give someone if they're leveraging, whether be Seeking Alpha or just in general? What advice would you give them who are really focused on wealth preservation?
On the wealth preservation, I would say whether it's Seeking Alpha or any of the other platforms that are out there, if you have a financial advisor, you still want to own stocks that are going to do well. And if you're focused on income generation, you want to try to identify stocks that have a strong dividend safety score and a strong dividend growth score. I wouldn't worry about the yield too much. Really what it comes down to is, does the stock have a good dividend growth pattern? And if they keep upping their dividend consistently, that's a wonderful find. So what you want to make sure for that combination of income generation and capital preservation is you want to look to see that those metrics that are commonly monitored, and we make that easy with the Seeking Alpha platform, remain in a safe zone. So whether you're looking at the overall quant and the fundamental grades, and something doesn't necessarily always have to be a strong buy or buy. If you're focused on capital preservation, having it as a hold means that it'll probably trade in line with the sector, but you're also generating that income at the same time. What you want to watch out for, and you do need to pay attention to it, at least, at a monthly basis, and you want to find that discipline. If you have a stock, which could have like forever been a blue chip stock, and all of a sudden it falls into that sell or strong sell category, there's a reason why it's falling into that category. And I'm not necessarily referring to a correction in the share price, because corrections can happen at any time. There could be one individual at the company that does something that is less than desirable, or they can have a bad quarter. The overall fundamental directional grade could stay a hold, and you probably want to continue to hold that stock if you're building up generational wealth. However, if those fundamental factors start to really weaken below other companies in the sector, you don't want to hang on to that company. People often say to me, a lot of the stocks that we recommend tend to be breaking out through its 52-week highs, and their instant sort of reflex is like, why do I want to be chasing a stock? Don't we want to buy stocks that are at 52-week lows? And I'm like, do you really want to be buying a stock where they're doing something wrong? The stock price is at a 52-week low because they're not doing something right.
Yeah.
Stocks that are 52-week highs, they are doing something right, and that's why the stocks continue to appreciate. And there's a lot of empirical data out there that shows you are much better off buying a basket of stocks breaking through a 52-week high than a 52-week low. So if you have one of those stocks that maybe was a dividend aristocrat for a long time, or a blue chip company, but you see that those factor grades are starting to get into the D plus D F territory, that's not a stock that you want to hold on to, because you're losing money and you want your money to make money for you.
That's a really, really interesting take. And I don't think I've ever heard someone talk about it from that perspective. You let your winners ride. You maybe heard of that. But when I think about, the inverse of what you just said, Verizon, AT&T, right? Hitting multi-decade lows in Verizon, for example, yielding over 7 or 8% now, where a year ago they were yielding 4% or 4.5%. Not like, that's that quote from Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. So you're saying, when looking at, correct me if I'm wrong, if I understood that correctly, that quantitative analysis is more so focused on, letting your winners continue to be winners versus chasing losers.
Right. That's absolutely correct. And what the quantitative scores will show you is when a company is becoming a loser. And we're, as I mentioned, we're looking at historical data and we're looking at forward data. And if you see data on both sides where it's not scoring well, something is not going right for that company. And, a good example could be something like, if you went back 15 years looking at Barnes and Noble. A lot of people would have said, oh, Amazon it's just like a real growth company. At the time, they weren't earning money. And the quant system wouldn't have told you necessarily to buy Amazon at the time. It may have been a hold. It probably was quite a while before I went to buy, because there is a valuation aspect that we do bring into our model. But you would have clearly seen that something was wrong at Barnes and Noble. Their numbers on a historical basis, were showing weakness. And then on a forward basis, they were showing weakness. So hypothetically, if that were a blue chip stock and you had
Yeah.
owned it for a decade, if you start to see that the fundamentals are poor from a historical standpoint and the forward estimates as well, you don't want to hang on to it. You want to put your money where it's safe and where it's going to grow for you. And even if you're focused on income generation, Verizon's a great example. Yeah, the yield was good, but the stock has fallen like
Yeah.
who knows how much. So it's more than washed out anything you've gained in your dividend yield.
It's such an interesting take because I think about it, right? I always find myself saying, and I read the comments all the time, oh, I'd love to buy Apple, Microsoft, or PepsiCo, but they're at all-time highs, right? Oh,
Right.
I love to buy it, but it's too overvalued, right? I've been hearing people say that since 2010,
Right.
right? Like I can't buy Microsoft because it's too expensive. And what you're saying is as long as the fundamentals are intact, you're not paying crazy PEs for a company like Microsoft, but you're saying focus on where the quantitative analysis is strong and the stock should continue, like it should continue down that path is what
Right. And those are really good examples because our overall directional recommendation on an Apple or an Amazon or a Tesla could have been a hold and it would have been a strong buy. But I'm going to share my screen with you again. And what's important is that people make these decisions based on the research that they perform, and the quant gets you there. It makes it a lot easier for you. So I'm going to switch to screen here, and I'm going to actually change this to Tesla. So we're going to click on Tesla, and that's going to come up, and you're going to see that's a hold recommendation right there. And like many of these hyper growth stocks, that valuation grade would be an F because the PEs are just in the stratosphere, the EV to EBITDA, the price to sales. But what you can do, and I'm going to click on that, you could actually see like this is just a very expensive stock across the board. So it's hard to justify that valuation. But often when you scroll down here, you might find something like a PEG ratio. And a PEG is a combination of PE and growth. And I actually love that ratio because it helps you look at growth at the same time as looking at a conventional value metric. A lot of times I could see like D's across the board, but at that PEG, I'll see an A. So as an investor, you could say, okay, well, if I look at this one valuation metric, it's actually not so bad. So if you're a proponent for growth stocks and something has a value grade that might be low overall, you could still do a deeper dive and say, oh, well, this particular metric which I like is actually still attractive. So let me see if I can find maybe with Amazon. Let's see where that's coming up. So we're going to take a look at Amazon. Amazon's pretty expensive too across the board. Trying to think of a company that might, let's take a look at Facebook or Meta. All right. So Meta is a good example. So Meta, we actually have a strong buy on right now. The overall valuation grade is a D plus. You can see the conventional metrics are pretty expensive. So if you look at PE, it's at 38 times versus the sector at 15 times. Whether you're looking at PE on a GAAP basis or non-GAAP, it's pretty expensive. And the forward PE comes in at C minus. But if you look at the PEG ratio, which again is that combination, you can actually just hover over it. And we sort of give the definitions for each of these ratios so people know exactly what it is. It shows you the PEG ratio is a combination of PE and earnings per share growth. It stands at a B. So it's actually attractive compared to the sector, the multiple being 1.3 times versus 1.66. So even if this stock were at a hold and say that valuation score was a D, you might still be able to find a metric that makes the stock look attractive and justify it. So this gives people the ability to really use their own research and their own opinions while we provide some guidelines there.
I really like the PEG ratio there. So, or the PEG when looking at and comparing different stocks to their sector, when I think about, when you compare Costco versus maybe another, consumer staple company like I'm trying to think, Kimberly-Clark, for example, they should be night and day, right?
Yeah, it's interesting. I mean, like Costco is a company that people absolutely love. Their stores are tremendous. Um, and the stock, has done, especially during the pandemic, it did really well. But you could see the stock is really super expensive now.
Yeah.
But if you wanted to make a case as an investor, you could see EV to sales is at a B. You can see price to sales is at a C plus. So even though most of these other metrics are really, really expensive, if you really like the name a lot, at least you could find, one or two metrics in the value camp that could justify it at that level.
Yeah. And it is interesting, like, some stocks, they just carry that premium, whether, it's a Dividend Aristocrat or, the Warren Buffett effect. As soon as Warren Buffett buys it, it automatically gets that premium valuation. Let me go ahead and let me take a second. Let me share my screen and let's take a look at a few Dividend Aristocrats. So Steve, I'd love to get your perspective here. Let's say, for example, I'm a new investor and I just put together this portfolio on Seeking Alpha. This is, maybe a watch list. This list specifically is just the Dividend Aristocrats. Whatever the list may be, let's say you build a portfolio in Seeking Alpha. What should I be looking at here, right? There's a ton of information. My focus, using this example, is I want a good balance of a good dividend and dividend growth over the coming years. What should I be looking at?
Well, actually, you mentioned something that's key there. If you come to Seeking Alpha, really the first thing you want to do is upload your portfolio, because you want to see how your stocks score compared to other stocks in the sector. And loading up a portfolio is super easy. You just go to the portfolio tool and you put the ticker symbols in. If you have a lot of companies, you can even have like 500 stocks. And if you have it listed on an Excel sheet, or you already have a brokerage account set up, you literally could just like link your brokerage account to Seeking Alpha and we'll pull the names in for your portfolio. Or if you have an Excel sheet, you can copy and paste the symbols of the company or the names of the companies right into the portfolio tool, and it will load your portfolio up right away. And then you get this great picture that you're seeing with the Dividend Aristocrats. So, the first thing I'm looking at here is VFC. So I just see the red right away on VFC, and it makes me a little bit concerned. VF Corporation, it's got that cell on it, and you can see that there, if you were to click on that, and so why don't you actually click on the ticker symbol? So you can see, so people will see right away that there's a warning banner and it says VFC is at high risk of cutting its dividend. And what you see immediately on the right rail are sort of the quant cell and the factor grades. The factor grades, again, those revolve around the fundamentals of a company, not necessarily the same as the dividend safety. You can have companies actually that have cut their dividend where those factor grades might be pretty strong. But if you are dependent on watching dividends, if you scroll down, you'll see that dividend safety grade is an F. So this is like one of the aristocrats that people could really be in love with, despite the fact that the stock is down almost 30% for the year. And if you look back for a 1 year period, the stock is down 57%. So, why is this looking poor? You see the factor grades where, growth is an F, profitability is an F. The revisions grade, which is the factor that looks at the number of analysts moving an estimate up or down versus the sector. And you can see this Dividend Aristocrat, again, we were talking about sort of forward numbers. So here you can see on a historical basis, if you were to click into the growth grade, you would see what it looks like on a historical basis. And then if you click on the revisions, it gives you an idea of that forward-looking number. But then when you scroll down and you click on dividend safety, you'll see why that banner is there. So let's click on dividend safety.
Mm-hmm.
And you can see that the cash payout is not an attractive grade. The dividend payout is not attractive at all at an F. That is way, way higher than the rest of the sector at 500%. If you look at the cash flow payout, you can see that's a D. That, again, is much higher than the rest of the sector. Scroll down a little bit more, and there's that coveted dividend coverage ratio, which is at a D, lower than the sector. interest coverage is about in line with the sector. But then, like if you look at a couple of the debt metrics, those are all in the D category. Cash from operations is in negative territory at an F. Cash per share is a C minus. And then if you go down, there's just other important metrics that we look at, like that 60-month capital asset pricing, the sustainable growth rate, the dividend growth rate, the dividend coverage ratio, and that's widely looked at as well, is a D minus. Hence, you can see why it's got this dividend safety of F and the warning banner. So this is a dividend aristocrat. You want to be careful. You don't want to be married to a name just because it's a dividend aristocrat.
Yeah. And if we go back over here and we look at the screener here, and if we look at, let's say, for example, these are the highest rated dividend aristocrats, Caterpillar. And, this is so interesting. Caterpillar and ExxonMobil, very, very different. Energy stock, industrial stock. And then you have Coca-Cola, which I don't think would surprise anyone. But what's interesting is, looking at it from this perspective, okay, which one of these companies, like, for example, Cincinnati Financial, 6-7 years ago when I was first building my portfolio, I had Cincinnati Financial on my radar because they were a dividend aristocrat. I never ended up pulling the trigger and buying it, but it's interesting to see, okay, it has a really, really low quant score. And then Hormel Foods, right? This was one of the poster childs of the pandemic, and it's got one of the lowest quant scores of all dividend aristocrats.
I'm so glad that you actually brought the screen up that way. And if you click on the quant score again, you could have a portfolio of your dividend aristocrats, but occasionally, as you have fresh money coming in, or you have cash coming in from dividends, you want to put it to work in the companies that have strong scores, and you want to put less money to work in the ones that have poor scores. So, this is a way of, managing, again, on a monthly basis. You could see the companies that look strong from a fundamental perspective, as well as that dividend safety perspective. So, the dividend aristocrats, a number of those companies could be holds, and a number of them could be buys or strong buys. You want to put your money into work where the stocks are attractive. And that's, a great way to utilize this tool, where you can have a consistent portfolio of names, but you're not doing it on an equal weighted basis. You're putting your fresh capital to work in the names that have the best fundamentals.
I like that. That's really actionable as well. And I think it's, a lot of people question, well, do I drip back into the same stock? What do I do with that money? Where do I put new capital? I think that's something that people can actually, is tangible, and it's something that they could consider implementing in their own discipline as they go forward with how they allocate their money. And where to put it. It gives them a direction, and I like that. Not everybody's going to take that advice, obviously, but I think there's quite a few people out there that are looking for direction and looking for a methodical approach of reinvesting their dividends, and that may be something to consider. So I like that.
Yeah, it's really important because companies aren't stagnant. Changes occur, and growth rates for sectors and industries are different. So I think a perfect example is if you take a look at Caterpillar. This company has been around a really, really long time. And, throughout their history, there have been periods, if you went back maybe 30 years or 20 years, where it wasn't so, rosy for Caterpillar, which was considered a Rust Belt stock. But now, when you take a look at it, this is a name that's often mentioned with artificial intelligence. And the company's done a fantastic job with integrating software into their equipment. And it readily, if you take a look at artificial intelligence ETFs, you see Caterpillar in there because of the strides that they have made. So this is a company which is a perfect example. It's a dividend aristocrat, but they're managing themselves really well, and they're in a sector that's doing really well. So when you're putting money to work, why would you put it into something where the company has not been doing well versus an opportunity like this to be investing in the company that is doing well and is still attractive?
Yeah, I think what's going to be really difficult for a lot of people is a lot of investors, they've heard time and time again, be greedy when others are, be fearful when others are greedy, and greedy when others are fearful. And they're going to see Verizon, and they're going to think Verizon, oh, it's on sale. but
Really
it
good
may be
point.
actually a yield trap, and they might be more inclined to go value hunting in that regard and put their capital in Verizon, versus a company that may be near its 52-week high in a company like Caterpillar.
Really good point. I'm glad you mentioned that. That saying, for the most part, should be utilized when the overall market and economy is going into a corrective phase or crisis. Okay. That is when you want to be greedy. When the market has pulled back 20% or 30%, and the talking heads on TV are saying things are going to get worse, things are going to get worse, and the market is just coming off sharply, that is when you want to be greedy. Okay. You don't want to do it when we're sort of in a normalized environment and a company has been doing poorly for years on end. Okay.
Yeah.
There's nothing to be greedy about that. You're just putting good money after bad. However, if you are in an environment where we're sort of in a crisis mode, if I had a superpower, it would be to ignore the gyrations and the fear and anxiety that is caused by the gyrations in the market, and just stay disciplined on a monthly basis, no matter what's going on. Okay. Just continue to with a monthly pattern of buying stocks and looking at the stocks that have the better fundamentals. Because actually, when you go into like a fearful period for the market, sometimes the companies with the best fundamentals that are going to sell off the most. And the reason being is those are names that have done well. They're liquid and people could raise cash. So when they're fearful, they're going to sell the stocks where it's easiest to raise cash. And a lot of times that could be companies with strong fundamentals. And that's the point that you want to be greedy, is when those stocks come off with the overall market. If you're looking at something like Verizon or AT&T, which has just been suffering for decades, and you keep thinking, oh, that yield is getting more attractive, the company itself is not getting more attractive. It's not like they're developing new products that are going to change the world and be disruptive. They're just doing the same old thing that they've been doing, and it's not working.
Yeah. And that's such a great point. When you were saying that, I was thinking, I can't tell you how long I've heard people talk about AT&T, that I'm going value hunting because AT&T has a low PE. It's, it's a household brand, et cetera, et cetera. But it's been in this never ending rut. It's really opened my eyes to a new way of thinking. And I mean this honestly. Before, I only looked at it in one way, where it's you go value hunting. Where's the greatest value? And you can kind of get trapped in, or at least this is how I've seen it, you get trapped in this current mindset of what's going on right now versus what's the potential a year, 2, 3, a decade out. Is Verizon going to be outperforming a company like a Caterpillar or a Microsoft? And that's really, really interesting.
Yeah, and the thing is, the great thing about the quant grades is at some point that could happen. And if you take a look at the growth grade, you'll see the forward growth grades will have high grades. Like they potentially could be an A, A plus, A minus, B plus. And if you see those forward growth grades with those strong investment metrics, the company is doing something right, because the analysts that cover the company are moving those growth grades up. But if you have that Dividend Aristocrat and the future growth grades look worse than the historical ones, you've got a problem.
Well, Steve, thank you so much for your time. I probably could ask another 20, 30 questions. This video would go on for hours. Hopefully we'll see you back here very, very soon.
My pleasure.